So we're nowhere near the metrics of the prior bull markets in terms of what is the multiple gain over the span of, let's say, a decade. We're nowhere near close. If we matched those, merely matched the geometrics of those moves, would be $8,000 gold. And so people, well, that's outlandish. Well, I mean, it's nothing. You're repeating history. And right now, we argue you've got more powerful, potent technical and fundamental technicals out there in these other major asset categories to help drive gold, meaning drive the central banks into panic, and therefore drive gold to the north in a big way, possibly even much bigger than an eightfold move.
Gold has recently surged past a crucial resistance level, pushing its price above $2,000 and approaching $2,500. This movement reflects a significant shift in investor confidence, indicating that the rise is more than just a fleeting spike. Silver has mirrored this trend, climbing from approximately $20 to nearly $32, although it's now hovering just below $30. This upward trajectory in both metals is primarily attributed to the US dollar index's decline, which had previously maintained a level above 104.40 but has now dropped below 101. This weakening of the dollar highlights increasing concerns about the stability of fiat currencies amid inflation and economic instability. Meanwhile, the bond market has experienced a notable rebound. Bond prices have surpassed their quarterly momentum ceiling from just above 120 to 124 and 125. This shift indicates investors' growing preference for Treasury bonds, driven by expectations of potential rate cuts and a noticeable slowdown in stock market growth. The shift from equities to lower-risk investments reflects a broader reassessment of risk in the current economic climate. In his recent interview with SOAR Financial, momentum analyst Michael Oliver highlighted that gold has historically achieved gains as high as eightfold during past bull markets. Although gold has already doubled since its lows in 2015, Oliver suggests that there remains significant potential for further upward movement if these historical patterns remain true. Silver, too, could see a meteoric rise to levels that might seem improbable today, but are entirely within reach given the current economic backdrop. Michael predicted that gold could soar to $8,000 per ounce or more, while silver might climb to a few $100s per ounce. While these projections aren't guaranteed, he illustrates the magnitude of the shift that could occur as market momentum continues to pivot in favor of precious metals, highlighting an evolving narrative of economic uncertainty and shifting investment strategies. Before diving into Michael Oliver's insights, subscribe and turn on notifications to stay updated with all our latest content. Thanks for watching and enjoy the video.
We're talking long into the debt market here. It's because asset managers begin to reallocate assets out of that which they perceive to be higher risk, less reward, into something lower risk, more reward. And that would be the T-bond market. Whereas a lot of them perceive the stock market to be less reward, higher risk potential. Now they have to be long because they're competing with other asset managers. And if you're not long and it's going up, you lose customers. But there's a lot of suspicious asset managers out there who are ready to make that shift. And they've already begun to. You can see it both in the T-bond upside action. You can see it in the stall in the stock market. And you can see it in the gold surge that we've had since late March. So there's been some asset class shift out of those three categories. The dollar foreign exchange, major foreign exchange. Again, the dollar is inverse of primarily the euro and the yen. That comprises like 70% of it, of the dollar index. It has been dead as a doornail for almost 2 years, where after that collapse we had in 2022, we were up at $115 index. We collapsed down near 100. And since then, since early 2023, the dollar has more or less gone sideways in about a single percentage range. Up, down, but going nowhere. So it was a non-event. It was the quiet one, we called it. Watch out for the quiet one sitting in the corner. It broke its quarterly momentum to the downside. Again, so another major asset category that where quarterly momentum is looked at as our trend assessment. It is now freshly broken to the downside. So again, gold upside, March. A couple of months later, bonds upside. And over the last month, dollar downside. The only one that's waiting is again what I described with the NASDAQ 100, the floor underneath quarterly momentum on the stock market. That's the last one to complete, and I think it will, meaning break to the downside. That means all those four major asset categories will have decided their new direction. In this case, we're talking long gold, long T-bonds, short stocks, short dollar. That's how we see the mix right now. If you look at the last couple of bull markets in gold, the mid-1970s to 1980, gold was in the fixed price in the 30s. It went to 850, 1980. And then from 2000 to 2011, 10, 11-year bull market went from $260 to $1,920. You had eightfold moves. 8+ fold moves over the span of a decade, let's say, or somewhat close to a decade either side. Well, we made a low in 2015, December, just above 1,050 gold. We've now doubled that and a little bit more, 2,500. So we're nowhere near the metrics of the prior bull markets in terms of what is the multiple gain over the span of, let's say, a decade. We're nowhere near close. If we matched those, merely matched the geometrics of those moves, would be $8,000 gold. And so people, that's outlandish. Well, I mean, it's nothing. You're repeating history. And right now, we argue you've got more powerful, potent technical and fundamental technicals out there in these other major asset categories to help drive gold, meaning drive the central banks into panic, and therefore drive gold to the north in a big way, possibly even much bigger than an eightfold move.
Federal Reserve Chairman Jerome Powell recently expressed growing confidence that inflation is on the brink of being under control, which paves the way for potential interest rate cuts in the coming month. At the Jackson Hole Symposium, Powell highlighted the significant cooling of inflation from its peak in 2022. The U.S. job market has also weakened, with the unemployment rate rising slightly. To address these economic shifts, Powell suggests that reducing interest rates, which have been high for over a year, might be necessary to prevent further job market deterioration. However, Michael Oliver warns that history suggests caution. When the Fed has raised rates and paused before cutting them, markets have often experienced a temporary rally, followed by a significant downturn. In 2000 and 2007, for example, the Fed's rate cuts initially buoyed the market, but were followed by severe declines. This pattern implies that the current market optimism surrounding potential rate cuts might be premature. The bull market, buoyed by years of cheap money and excessive financial leverage, is at risk of significant corrections. The end of this era of easy credit will likely reveal the financial flaws hidden beneath the surface. Given the unprecedented size and duration of the current market bubble, a major financial correction could be on the horizon, highlighting the need for careful consideration of historical trends and their potential impact on future market behavior.
I think it's going to be very weak, and usually the stock market will lead overt economic weakness. Now, we've had a lot below the surface that the Fed is, no, the economy's strong, job market's strong, and everybody knows that was baloney. And now suddenly, with the huge revision in the job numbers going back the last year, all those numbers were bullshit. So who can believe any of the numbers, frankly, if that one was so far off target? But anyway, it was very weak, and the Fed is going to cut. There's no question. And the issue for the stock market, though, is when the Fed cuts after a period of, let's say, rate rises and then pause. We took rates up a year or so ago, and then they paused for a good period of time now, and then they'll follow with a cut. Okay, the same thing happened in 2000 to 2001. They ceased rate rises in middle of 2000. They started cutting rates in January 2001. Okay, then the next time we had a period of rate rises and then pause was 2006, big long pause till 2007. They told us, there's nothing wrong with the mortgage market. Bernanke said it's totally manageable. And then in September of 2007, mid-September, S&P was about 2% off of what 2 or 3% short of what the high would ultimately be. They cut rates by half a point, and it was a shock and surprise. Not like this time around. Everybody anticipates it, and they're correct. The Fed has said they're going to do it. Back then, it was an ambush. And Wall Street quotes that I've gone back and looked at from various financial sources were absolutely surprised. They were having champagne and cookies, one guy said. And it was a Christmas present no one expected. That's what another guy said. So anyway, but what happened then is the market went up for 3 or 4 weeks after that cut, and that was the top. And it went to hell for the next 2 years, despite the fact that the Fed cut rates all the way down. Okay. And then back to that 2000, 2001 period, In January 2000, the first day and then the last day of the month, 2 cuts in 1 month, they started cutting rates. The market had a little brief hiccup rally, and then the collapse really began, and they cut rates all the way down. So anybody who's applauding the notion the Fed's going to cut rates, go back and look at history. Okay, the last 2 major bull market tops, you could have circled the point at which they cut rates, give or take a bit, and a bit, that's all. And you would have shorted the high. So there, that's what history says. I think it's the same thing this time, and I think the data points will start to collapse. Why? We've had the biggest bull market in U.S. history, painted and created by financial excess, free money for about 10 of the last 15 years. Money was free. A lot of decisions were made based on free money, commitments by corporations, debt commitments, personal family commitments, mortgage commitments, all kinds of commitments that people, corporations, governments make based on the assumption that money is cheap and going to stay there. That's been ripped off, and now suddenly those errors are exposing themselves, or expose themselves the more as time goes by, where suddenly commitments were made based on several fundamental assumptions, the one primary being what's the price of money. Okay, so anyway, those errors will show themselves in ways that, heck, I can't even predict. I mean, it won't just be one area like it was back in 2007-8. It was the mortgage market. This time it's likely to be broader and likely to be in areas people aren't even thinking about, because the bull market was a 7 to 15-fold, depending on S&P or NASDAQ, that's like triple to quadruple any prior bull market. And it lasted about 3 times longer than any prior bull market. So it's a massive bubble. And when it breaks, there'll be massive bubble breakage with all kinds of fundamental factors in play.
Gold's resilience is evident as it maintains crucial near-term support levels and aims to break above the previous day's peak of $2,528.93. Currently, gold is trading within Wednesday's price range, with a high of $2,528.66 and a low of $2,504. Should gold push past the $2,528.93 mark, it may signal the start of a sustained upward trend. Share your thoughts in the comments below. Don't forget to like this video, subscribe to the channel, and turn on post notifications for more content like this. Until next time.